Welcome back to Financial Fortitude, the podcast dedicated to empowering high-income professionals to navigate complex financial landscapes and build lasting wealth. I'm your host, Michael Acosta, and joining me as always is my co-host, Brady Hemmerling. How's it going, Brady?
Michael, I'm doing great, and I am very excited about today's topic because it's one of those that affects many of our listeners, restricted stock units or RSUs. These can be a significant part of anyone's compensation package, but without proper management, they can lead to missed opportunities.
In today's episode, top 4 important considerations for professionals with RSUs. We'll delve into key strategies to ensure you're making the most of these benefits, from understanding tax implications to aligning RSUs with your financial goals. We've got you covered.
So whether you're brand new to RSUs or looking to optimize your existing strategy, stay tuned because we're going to dive in.
Welcome to Financial Fortitude, a podcast for high earners, families, and business owners. We are your hosts, Michael Acosta
and Brady Hemmerling. Each week, we bring purpose-driven financial guidance to you so you can be assured you're on the right path. If you're looking to become an extraordinary wealth builder, let's dive in.
Brady, I know restricted stock units, also known as RSUs, because why not have a bunch of acronyms in the financial services industry, right? Are something that come up more and more, especially for young professionals that tend to work for companies or employers that want to incentivize them by giving them stock in the company that they work for, right? It's a way to incentivize. It's a way to align the growth of the company expectations with the employees because there's a linked incentive, right? And we tend to see this more in the tech space. Would you agree?
I would tend to agree. Yep. In many instances, we see RSUs in companies like Meta, Google, Amazon, Credit Karma, right? A lot of those technology-based companies are those who are not only giving employees competitive salaries, but also providing incentive compensation in the form of stock as opposed to just simply bonus or cash.
And albeit when you get that as a professional, when you get that employment offer, compensation package, and you see the restricted stock units on there, and let's say that it's over 50% of your annual expected income, it can seem pretty exciting. We've seen scenarios where, professional is receiving $250,000 in base salary and then another $350,000 to $450,000 in restricted stock units. That's pretty compelling. That's pretty exciting. Now, there are obviously risks, and that's one of the areas that we're going to talk about today, are the risks that come along with this. But for those who may not know what a restricted stock unit is, let's break that down for them.
Yep. So again, restricted stock unit is essentially just a form of, I would even call it bonus compensation, right? If I were to get an offer from Google or Meta as an example, they may promise to pay me $250,000 as a base salary. And what they also may promise to pay me is each year for the next 5 years, 10 years, right? Whatever that period of time where they're extending that offer. What they're essentially saying is that each year we are going to pay you a specific amount of stock shares in our company. And those stock shares are going to equate to a value of some kind, another 100,000, 200,000. So each year I'm working for Meta or Google or Credit Karma or anywhere else, right? I'm receiving my base salary. And then once per year, I'll have a vesting event or an event where I essentially am receiving now the shares that were promised to me at that time. And come year end, I now have got $250,000 in base salary, and I've now got $250,000 in Meta stock sitting in a brokerage account somewhere with my name on it.
Got you. Now, because I am a nerd and I'm very technical, I'm going to add in what we pulled from Investopedia as far as like the definition that they provide as a resource. So again, a restricted stock unit, RSU, is an award of stock shares usually given as a form of employee compensation, just like Brady mentioned. The recipient must meet certain conditions before these restricted stock units are transferred to the owner. Some of those restrictions might consist of working for an extended period of time at the company. Another one would be not dying untimely before you meet that criteria. Because a lot of the times with companies, and you would have to review with someone the contract that is being agreed upon with these RSUs, whether or not they vest upon death or not. In most instances, they won't. Continued, restricted stock units are issued to employees through a vesting plan. So when you think about a vesting plan, you could consider referring to or thinking about your 401k plan or 403b plan, right? Typically, there's going to be some sort of vesting schedule for any of the contributions that are provided by your employer, such as profit sharing. In this case, vesting schedule might be 1 year, depending on when the grant of RSUs were provided to you from an unvested perspective. So again, through a vesting plan and distribution schedule after they achieve required performance milestones or upon remaining with their employer for a particular length of time. And lastly, restricted stock units give employees interest in their employer's equity, but have no tangible value until they are vested. Now that's a little confusing, right? So it's almost like phantom value.
Yes. And I was going to say, let's break that down. Like how do you characterize what that value is for a client? If I step into your office and say, hey, I've got a $250,000 base salary and $100,000 of stock units this year that I'm expecting, but they don't vest until next year. What value does that look like for me, or how do you start that conversation in helping someone understand what they're getting?
We've echoed this in a lot of different episodes, but financial planning is more of an art than a science. And every advisor is going to be more aggressive or more conservative than the others, right? Just depending on where they're at in their profession, career, practice, and their philosophies. I tend to side with taking a conservative approach in that I really don't incorporate the value of those RSUs that are unvested into the fixed recurring strategies that we have in place around saving and investing, because they're not realized yet. We haven't received them. They're technically not tangible, just like that definition states. So until it's in hand, we can plan around it and say, okay, it's going to be phenomenal when this is realized, and we can make a game time decision based off of what we've been building on up to that point. But I don't want to go spending money that I haven't received yet, because it's not contractually guaranteed if you don't meet the milestones or the vesting schedule requirements.
Sure. It's like a bonus, right? In some instances, You're not advising clients or encouraging clients to go spend a bonus before they ultimately get paid or know they're going to get paid on their bonus.
Right. And one of the risks that we haven't really chimed on yet is, well, what if you decide that you get an offer from another company that's giving you even a higher amount of RSUs and base compensation and you decide to leave? Well, if we run the numbers, it could make sense for you to just forego the unvested shares and receive the new unvested shares from the new company, right? So, those are all risks, and we don't want to spend money that we don't have yet. So to finish off this definition by Investopedia, the RSUs are assigned at a fair market value when they vest. So restricted stock units are considered income once vested, and a portion of these shares are withheld to pay income taxes once they're vested. The employee then receives the remaining shares and has the right to sell them. You can keep them in the existing company ticker holding if you have a lot of conviction for that company, and we can talk about, diversification and why that's important. Or if you have no emotional ties to the company other than, hey, this is just a bonus that I get on a recurring basis, again, you can transfer the shares to your own personal investment account. You can sell them. You can divest. You can do whatever you want, more or less.
So let's talk through that a little bit. So if I'm an employee of a company, I've got base compensation, I've got this RSU package, and those RSUs truly haven't vested yet, right? I haven't gotten paid my bonus. Right? Why do those RSUs, or why may those RSUs incentivize me more than just a regular bonus payment? Right? Why would a company offer an RSU instead of a bonus?
So a company is going to offer, in my opinion, an RSU instead of a bonus because of the linked incentive for you as an employee to work harder so that the company stock price goes up. Right now, obviously, there's not a one-to-one correlation to how hard an employee works and where the stock price actually goes. Right? There are other variables associated with where the stock price goes, some external variables that are outside of the employee and employer's control. But in instances, your bonus could be much higher as opposed to the company saying, hey, we're going to give you a percentage of the revenues, which is typically where a bonus comes from.
That makes sense, right? A company, instead of just giving you a cash payment, is saying, hey, if you work hard here and you really improve what is the profitability of this business, in theory, it should reflect in the stock price, and it gives the employees more upside potential on their bonus. They're directly linked with the company's performance.
Absolutely. And again, some external variables need to be taken into account, because we've heard horror stories where, RSUs were granted, the employee stayed long enough to where they were vested, but then the company goes under. Well, guess what? If the company goes under, those stocks are worth nothing, right? If the stock price goes down to zero. So that's your risk. On the upside, we've seen instances where, it's a startup company, there's not a ton of excess revenue, so they issue unvested shares of the company's stock. And, maybe it's trading at $25 a share as a startup. A couple years later, it spikes and now it's trading at $600 a share. If you were there to participate in that exponential growth, well, you probably made out like a bandit.
In that instance, absolutely, right? It's the risk reward of taking compensation in the form of stock rather than just taking compensation in the form of cash.
Correct. And again, when you're looking at these growth type companies where they're really using the excess revenues to pour back into further research and development of their products, their services, who they are, granting stocks or shares or equity in the company, it's easier. It's more simplified than not. It's a matter of, instead of taking that excess cash flow and giving it to the employees.
So in that instance, when you're working for a tech company, they have two options to pay employees. They can take money out of their bank account to pay them, or they could issue stock shares to pay them in the future with the promise of more upside potential. For those companies, it's cheaper, right, and perhaps easier in the moment to issue stock shares and basically diversify out of their own ownership of the company, knowing that, hey, everyone's incentivized to work harder here, rather than take cash out of their bank account to pay the employees.
Correct. Well, let's talk about one of the big elephants in the room, which is how are these taxed? And when they vest, how does this impact my tax bill at the end of the year? And what should I be considering? So why don't you break down for us how restricted stock units are taxed?
So first thing to note is RSUs are not taxed when they're awarded or granted to you. If you're my employer and say, hey, I promise you today that in 1 year from now, these restricted stock units are going to vest, right? I don't pay a tax bill today for that. I only owe tax when I actually receive the stock shares, right? Just like I only pay tax when I receive a bonus. So when RSUs do in fact vest, I have legal ownership and access to them in my RSU account. At that time, they are considered ordinary income, just as if I were to get a cash bonus payment. And they are considered ordinary income based on the value of those shares at the time of vesting. So if I've got an RSU vest that happens and it's $100,000 worth of stock shares in my company, in that moment and for that year, I am going to owe taxes on that $100,000 based on the income that I've earned from my base salary plus the income that I've earned from my RSU payments.
Right. And just to clarify, it's the fair market value of the stock shares at the time that they vest, not the time that they're granted to you or awarded to you.
Yes. Yep.
Gotcha. So now that these shares are vested, what are some of the options that these recipients have for covering the assumed tax bill or the liability that comes along with them?
Yeah, great question. So typically, let's assume if I get a $100,000 RSU vest this year, and let's say for very simple math, I'm in the 20% tax bracket. In this example, I will owe $20,000 to the IRS based on the shares that I have received from my company. It's just a bonus payment. So in this instance, I have a few different options, right? The first option is I can elect with my employer to essentially sell the shares right away when they vest, and my employer will send that $20,000 off to the IRS, effectively paying my tax bill for me. Instead of $100,000 of stock, I now would have $80,000 of stock. Right? For better or for worse, it's pretty simple. Right? They're prepaying or withholding the tax for me.
Uncle Sam always has to get their cut.
Yep. Otherwise, I could say, you know what? I want all $100,000 worth of shares, and I'm willing to come out of pocket and pay the taxes myself rather than forego my ownership to the shares. Right? I can essentially send the IRS a cash payment used to cover the tax instead of selling. From a strategy perspective, it really just depends, right? On your risk tolerance, on your confidence in the shares, what your tax situation ultimately is going to look like. And that's where working with a tax professional and a financial professional is really going to help in saying, hey, what might be my options here and what is the best path to address the potential tax?
Correct. And nothing that we're sharing today is any sort of direct statement to you on, any sort of tax strategies that we think you should implement, right? Because like Brady mentioned, we're not CPAs, we're not tax professionals, and it's important to consult with a trusted tax professional or advisor when making these decisions. But as you plan ahead for those vesting events, things that you might consider consulting with your CPA or tax professional would be adjusting your W-4 to avoid underpayment penalties. So you don't want to be caught at the end of the year when you're getting your taxes finalized and owing a bigger bill than you anticipated, right? Or that you projected. You could also make estimated tax payments if your employer's not withholding enough. Okay. And so there are 4 times throughout the course of the year that you would just stroke a check or make a digital payment to the IRS, either, federally and or to the state. And so consult with your tax advisor to just make sure that you're not going to get caught off guard and that you're being as proactive as possible when making these decisions.
So with that in mind, I've gotten my RSU shares granted to me. The company's promised we're going to get paid, or I'm going to get paid. A year goes by, I've met all of the requirements. I get paid $100,000 worth of stock. I've either prepaid my taxes on my own or I've held back stock shares. My company's helped me do that to pay my tax bill. And now I've got the bonus in hand. Just like anyone else would get a bonus, I've got cash in my bank account. In this instance, I've got stock shares in my brokerage account. And now these assets are mine. So talk to us, Michael, about what choices or options do I have in regards to keeping those shares, and how might that impact me from a tax perspective? Things to consider on that end.
Well, you just said I have bonus in hand, and I got excited, and the first song that went off into my head was Creep, but more so Lifestyle Creep, right? So not exactly the same thing that was sung by TLC. Now,
see, I was thinking Akon, I'm So Paid, right? You're thinking the exact opposite.
Either one. But no, I mean, what you don't want to happen is the lifestyle creep, right? You get this bonus and now you're just on a spending frenzy, which again, we know that those who are listening are more prudent than that, because you're wanting to become an extraordinary wealth builder and achieve financial success and security. But you receive those. Now, as far as options, you can hold the shares, right, longer if you have a lot of conviction in the company. It's already being treated as ordinary income. And if it's being vested at fair market value, then on day one of you receiving it, there is no gain in the actual share, in theory. Now, you can hold the shares in the company if you have a lot of conviction and belief in the company that the stock's going to go up continually, longer term. And if you sell them before the end of a full year, 365 days plus a day, and you have a gain, then you're going to pay, short-term capital gains tax, which is really just additional ordinary income. If you hold it beyond that 365 plus 1 days, then it would be treated as long-term capital gains, and there are different taxes associated with the gain piece, right? So it's either 0%, 15%, or 20% currently based on IRS rules. For someone who's receiving RSUs, I would imagine that their long-term capital gains tax rate is going to be either 15 or 20%, just based on the income threshold limits.
Okay.
And so another way of breaking that down is if I have $100,000 worth of RSUs and I hold it for more than a year and they're now valued at $200,000, well, I now have a long-term capital gain, assuming I sold it, of $100,000. So that's where the 15% or 20% would be associated, would be the $100,000 gain. Now, why would I want to diversify? Why would I even want to sell these if I have conviction in them? Well, one main reason that comes to mind is you could be oversaturated or overconcentrated into an individual position, which could skyrocket your overall risk tolerance.
Break that down for us. Like, how is that risk elevated for someone who is getting RSU payments as forms of compensation?
Yeah, so I'll use the analogy of gambling. Okay, so if you've ever played roulette, it's the little thing that spins in a circle and it has a bunch of different numbers and colors on it, and you drop a marble in it and then the marble falls on one of the numbers or colors or both, right? Now, when you place your bets, you can place the bet on a single number. You can spread it across multiple numbers. You can choose even or odd. You can choose black or red or green, because there are a few green options on the dial that spins. If I put all of my bet, $100,000, on number 30, because that was my number in college and it's one of my favorite numbers, the probability of me hitting number 30 is probably very low. out of all the numbers on the actual dial. But if it does hit, I'm going to make it big, depending on my bet. As a way to diversify that, I could take my bet and I could spread it across 5, 10, 15, or 20 other numbers. I could even include thinking that it's going to be an odd number that hits versus an even number. I can hedge my bet and put odd and even, knowing that it's got to hit one of the two, right? So using that analogy, it's okay, well, if a large portion of my investable assets, let's just say I have $350,000 in investable assets based on where I'm at in my career, and I get $100,000 worth of RSUs and I hold it for a year and it's now valued at $200,000. Okay. Well, if that $200,000 is included in that $350,000 of total assets, that's a large percentage. That's over 50% of the value of my current assets. So what happens if that stock plummets? A larger portion of my wealth is erased from my balance sheet purely off of market volatility and turbulence.
Of that one company, combined with the fact that you're also still employed by that same company.
Correct.
Yep.
Correct. So this is where you have a decision that has to be made, right? You have to discern, does it make sense for me to hold all of these shares? Should I begin divesting some of them and reinvesting those in a larger basket of other companies that align with my values, right? Or my goals or my expectations? Or are there other goals on my balance sheet that require selling these shares for cash in hand for me to execute other things?
I think the funny question that we often ask, or at least interesting question that we ask, is for employees who are receiving RSU payments. If we were to flip the script and say, you know what, next year you're not getting an RSU payment. You're simply just getting a bonus payment, right? No more shares are going to vest next year. You're going to get a $100,000 bonus payment. If you were to receive the $100,000 bonus payment, would you invest 100% of it into your company stock? Right? Would that be the choice that you would make otherwise? And clients sit there and think about it, and many of them often say, well, no, right? And then we ask the question, well, why not? Well, hey, I know X, Y, and Z about my company. I work here. Also, that feels a little risky putting every single dollar that I have in one particular stock when me and my financial professional have discussed why diversification is important, why building a more bulletproof portfolio is important. Right? That doesn't align at all with the other strategy that we're building. You getting those RSU payments, anyone who's getting them, is essentially you getting a cash bonus payment and just investing 100% of that bonus into your company stock.
Yeah, and when you put it that way, it really clears the air and the vision for the client. Because they're not thinking of that for a couple of reasons. And there's a couple of emotional bias that are tied to that. One, many employees hesitate to sell because of loyalty or optimism about their company's future, right? You have overconfidence in the company based off of what you know around the performance of the company. But you may not be privy to everything that's going on with the company. The other is that you want to make sure that you're not getting off track with the purpose of your plan. I keep going back to this vision idea. The vision that you've outlined with your financial advisor is something that should be considered, your financial professional is something that should be considered and referenced often when these quote unquote RSU bonuses vest, because you need to be as purpose driven as possible with aligning those distributions, right? Or those awards that you're receiving that vest with your overall savings allocation, right? And that's where the diversification comes in, because it's more of protecting wealth and not questioning your loyalty to the company. Because at the end of the day, you might think that the company's loyal to you, but if there's financial hardship, that company has to make tough decisions, and you may not be one of those decisions that they make.
Yep. So with all of that in mind, then, we know, hey, what an RSU is, what the tax implications look when they're received, the importance of really considering diversification. Now, if I'm the client, or if clients are out there saying, hey, I just got a vest of RSUs, what should a potential plan look like, or what are some things to consider to step into a more diversified, a better rounded, a more purpose-driven approach?
Yeah, I would say you would need to have these game plan conversations outlined with your financial professional before the shares actually vest, right? Because you don't want to be reactive, you want to be proactive. But some of the things that come to mind would be periodic sales, right? Whether it's 100% of the shares that vest or just doing a portion of them, depending on, again, the overall conviction of the recipient, the client, in those shares in their company. But when you're going to do these periodic sales, you want to make sure that you're accounting for the tax ramifications. If you're doing it immediately once they vest, it's already taxed as ordinary income. If you're doing it 6 months later and there's a gain, you're going to fall into short-term capital gains, which again is additional ordinary income tax. If you do it beyond a year and there's a gain, long-term capital gains tax, which is different and a little bit more advantageous. So just make sure that you're outlining that and you're accounting for those additional potential liabilities at hand. And then figure out where, once you liquidate them or once you sell out of them, where are you actually going to put them? And how do we do this systematically? And referencing back to short-term, midterm, and long-term goals, short-term, midterm, and long-term buckets. Are we using these RSUs to jumpstart and, accelerate the funding of an emergency fund? Are we topping off the emergency fund because we've been diligent with putting money in there? Now we're starting to jumpstart our opportunity fund, which is that midterm bucket, right? The non-retirement after-tax investment bucket. Or are we looking at this as a way to do backdoor Roth contributions or some other sort of, longer-term bucket investment allocation, potentially even investment real estate? We work with clients who want to use these RSUs to be able to turn around and buy short-term rental properties, which then turn around and provide passive income. So the sky can be the limit. You just need to be able to recognize and work through what are the cause and effects of this decision.
Yep. And treating, I think the big consideration that we provide for many clients is truly understanding and treating RSUs as if they're truly a cash bonus, because it's ultimately the company just giving you a cash bonus in the form of shares. So knowing that that cash bonus is coming in, what's the plan for that bonus? How are we going to sell out of it over time to align back to your other goals? What tax considerations do we need to think about? And then I think the other small consideration is, hey, what are the rules inside of the plan? When you can go access, when you can go sell. There will be instances in some of these RSU plans where there are blackout periods, essentially where the company restricts trading, knowing that these shares are coming available to individuals.
Yeah, and if we're going to be textbook with some of these strategies, just to provide definition, you can sell to cover. So that's really just the idea of selling just enough of the shares that have vested to cover the tax bill, keeping the rest invested with the company. You could do a cashless exercise. Again, this is where you sell all the shares immediately upon vesting, then reinvest the proceeds based on your personal financial plan. We've talked about that. The third option would be hold and diversify gradually. And this is going to be where you hold the vested shares, but sell a portion periodically to be able to diversify in other areas, right? So again, all of this refers back to what is your ultimate vision and goals, and how can these help benefit the acceleration of you leveling up and hitting extraordinary wealth builder status?
So, Michael, with everything that we've talked about in this episode, what are some of the summary points and the highlights for anyone who either has RSUs currently or is being offered RSUs in some form of compensation arrangement? What are the big pieces that clients need to consider and some of the do's and don'ts?
Yeah, so I would say the top 4 important considerations for this would be goals-based allocations, purpose-driven allocations. If you're getting these RSUs and they're vested and you're liquidating them right away, or you're not and you're holding them, the decision needs to align with what you're ultimately trying to achieve. Are you saving up for a down payment on a home? Are you funding a child's education? Are you trying to juice up your emergency fund or any other retirement and investment accounts? Or do we need to use this to accelerate the payoff of high interest rate debt, right? Things that can be suffocating to your ability to hit extraordinary wealth builder status and just save for your future. Second would be retirement planning. So consider using these RSUs to max out 401k contributions or fund a Roth IRA, right? These can be viable options to jumpstart the acceleration of growth in your long-term bucket, right? Your retirement assets. You just need to make sure that you're aware of phase-out limits as a professional, because we're assuming if you're getting RSUs that you're probably making significant income. Thirdly, what's the opportunity cost? What's the opportunity cost of you liquidating them upon vesting versus holding them for 6 months and then divesting versus holding them longer term and then divesting, right? What are the risks that come along with that as far as where do we think the company's stock value is going to go? Is it going to go up? Is it going to go down? There's one thing that we know for certain when it comes to the stock market. It's either going to go up or it's going to go down. So how does that play into your overall, again, financial plan itself? there needs to be an emphasis on the importance of timely action to prevent those RSUs from becoming dead money. Again, we talked about that earlier. What happens if the company value goes significantly lower than expected or just goes out of business altogether? How are you protected against that? And a lot of that could be emotional bias. And then lastly, rebalancing, right? Look at your overall asset allocation, work with your financial professional to make sure that you're not over concentrated in an individual stock. An example I can give is, we spoke with somebody recently who had sizable assets and, a lot of cash on hand, which was the byproduct of just divesting a lot of their RSUs that they got each year, didn't know what to do with it, but then had probably 3x in unvested RSUs compared to the amount of cash that they had on hand. And this individual is telling me that they're a very conservative investor. Well, it's like, well, you are a conservative investor because you have a lot of cash on hand. However, 3 times what you have in cash is invested in a single company. Not necessarily your decision because they're unvested shares, but that would tell me that you're more of an aggressive investor because everything's in a singular stock, so very concentrated. So when there are opportunities to rebalance and diversify, take those opportunities. Consult with your CPA or tax professional just to make sure that you're not going to get caught off guard in the future when it's time to file your taxes. Now, from an overall risk, one thing that we didn't mention in depth was if you pass away untimely with a large percentage of unvested shares, they're likely not going to vest upon death for your surviving spouse or your estate or your children. So what are things that you can do to safeguard that? Well, refer back to episode 16 where we talk about this a little bit, not necessarily specific to RSUs themselves, but refer back to episode 16 titled Waiting on This Could Cost You More Than You Think, just so that you're taking the appropriate steps to beef up your financial immune system and protecting unrealized wealth that may not be realized due to an untimely passing.
Well, that's a wrap for today's episode of Financial Fortitude. If you've got RSUs in your compensation package, please do not let them go to waste and plan ahead. Diversify and put them to work towards your financial future.
And if you liked what you heard today, make sure to subscribe, share this episode, and drop us a review. It really helps us out. Plus, if you need help navigating your RSUs or want a second opinion on your financial strategy, don't hesitate to reach out to us directly by visiting us at www.genesiswealthplanning.com. And if you have questions or concerns or topics that you would like for us to discuss, go back to www.genesiswealthplanning.com/AMA.
Thanks for tuning in, everyone. Until next time, keep building that financial fortitude.
Are you considering hiring a financial advisor? If so, be sure to listen to episode 1 of Financial Fortitude. In this episode, we discuss the reasons why many people choose to hire a financial advisor and highlight the key qualities you should look for in the financial professional you decide to work with. This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Genesis Wealth Planning LLC, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. All scenarios and names mentioned herein are purely fictional and have been created solely for educational purposes. Any resemblance to existing situations, persons, or fictional characters is coincidental. The information presented should not be used as the basis for any specific investment advice. Michael Acosta and Brady are registered representatives and financial advisors of Park Avenue Securities, LLC, PAS. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Consolidated Planning Group, Inc. and Genesis Wealth Planning, LLC are not affiliates or subsidiaries of Park Avenue Securities or Guardian. Michael Acosta's California Insurance License Number 0M50974 and Brady Hemmerly's California Insurance License Number 4353077 7237198.7 expiration 527.